Hello, everyone. I hope that we're doing well. Today we'll be continuing on our journey of the accounting circle, and we'll be aiming to learn to prepare, a list of balances, identifying the debit and credit balances correctly, and then putting them into the trial balance. So we'll be able to record the trial balance and then, identify all of the different steps involved in accounting. So far, we have looked at how to identify transactions in previous videos, record journal entries, and post ledger entries. Please, particularly if you haven't listened to the videos on double entry principles, so double entry bookkeeping, part 1 and 2, please do that. It will be good for you to do that before starting the trial balance video. But if you have a proper understanding, let's move on to trial balance. What is trial balance? Trial balance is a list of all of the balances. So in the double entry bookkeeping part 2, we had looked at how to post transactions into the ledger account. So picking up all of those ledger accounts that we have prepared. So extracting all of those balances and then using that is all what we need to prepare our trial balance. So our trial balance is just a list of all of the balances of the ledger accounts. So all of the, the list of all of the balances extracted from the ledgers. So you would usually draw up the trial balance, at a very regular intervals. It could be, monthly, end of each month. And the reasons why we prepare a trial balance actually is just for us to check that everything has been done rightly. So it's to check for accuracy. Not forgetting that we said that, that both sides of the account have to be equal, right? So the debit entry of the account has to be equal to the credit entry. And the way we'll be able to ascertain that, this is accurate, this is exactly what it is drawing up the trial balance. So once we and then the trial balance also is the basis for the preparation of our final accounts. So our income statements, our statement of financial position would be needing our trial balance, to prepare those accounts. So trial balance is a list of all of the balances, all of the closing balances of the ledger accounts as at a specific date that we're preparing the trial balance. We've said it's prepared end of month, and then the both sides of the trial balance has to be equal. So the both sides of the trial balance has to be equal. Just to recall, we had mentioned the various stages of recording our transactions, right from identifying those transactions. So we identify a transaction, identify the elements of the transaction. We say what type of accounts we'll classify it in, what type of the 5 groups of accounts we'll classify as. Is there an asset, an expense? Is there a liability? Is there an income? Is there capital? And once we do that, we want to know whether there's been an increase, a decrease in all of these elements, and then that determines what, whether we're going to debit or credit. Our rule is that if there's been an increase in either it's an asset, it's an expense, it's a drawing, that we're going to be debiting those. So those would have a debit entry. And then for the others like income, liability, capital, all of those would have a credit entry. They will appear on the credit side of the account. Okay, and that's it. So we know that for our assets, here are assets, our expenses as well as our drawings, those would have a debit entry, whereas for our liabilities, our capital as well as our income, those would be credit entry. So all of the balances, all of the closing balances of all of those ledger accounts is then what we have here as our trial balance. So this is the trial balance of this company as at 6th of July. So these are all of the this is the name of all of the ledger accounts. So whether it's a bank ledger account, capital ledger account, and all of those, and these are the balances. So each of them could, it could have been a debit or a credit balance. So it could have been a debit or a credit balance. So if our balance brought down, like we discussed, in part 2 of double entry recording, that so if we have your balance brought down figure in your ledger account, so if you have your, so let's assume that you have your balance brought down on the debit side, you bring that in here and that will be on the debit side. So we had said that, when we look at the two sides of the T account, the one that is higher, you subtract the lower one from the higher one. So if maybe the debit side is higher than the credit side of the bank ledger account, we'll have a debit balance. And then you have your, balance carried down. And then the figure that you have as your balance carried down becomes your balance brought down for the next period. So it is then the balance brought down that you're going to be recording in your trial balance. Once you have all of those recordings of all of the balance brought down, they should be equal. The balances on the debit side, as well as the balance on the credit side, should sum up to give you an exact figure. In this case, we have 10,150, 10,150. If you find out that the balances on your trial balance is not balanced, that tells you already that there's been an error. There's been an error that you need to then go back to check where the mistake has been, and then you can correct the errors. Okay, so let's get started. How do we classify each of these transactions? So we have, and that's what I want, if you can pause the video and make an attempt. So you want to classify the following transactions as either having a debit entry, a debit balance, or a credit balance. So the first one says capital invested by the owner. So we have capital invested by the owner. We know capital invested by the owner is capital, so owner's contribution in the business. And we said for capital would have a credit. Capital would have a credit balance. Sales. We said sales income, revenue would also have a credit balance. So I hope you paused the video and then, you're just using this to see if you're right or wrong. Trade receivables is, it's a current asset. And we said assets would have a debit balance, so that should be a debit. Purchase returns is going to have a credit balance. Purchases itself would have a debit balance because purchases is an expenses. So purchases and expenses, when you return back what you have purchased back to your supplier, that would be a credit balance. So that should go credit. Wages is an expense. Expense has, you have to debit, has a debit balance. So expense, debit. Purchases, so here's the purchases. Purchases is an expense and that has a debit balance. So you see that purchases has a debit balance. Purchase returns, the opposite of purchase, has a credit balance. Bank loan is a liability. Bank loan is a liability, and we say liabilities should have a credit balance. Motor vehicle is an asset, a non-current asset. Asset should have a debit balance. So that should be debited. Rent received. So now you should take note because now there could be different type of rent. It could have been rent paid. If it were to be rent paid is an expense and that would have a debit balance. But rent received is an income, other income. Other income, because other ways that you can get income into your business apart from the sales that you make could be, based on rent received. You rent out a part of your office or your company and you're receiving rent from it. It could have been from commission, it could from interest income and all of those. So this is rent received and it is an income, and income should be credited. Trade payables is a liability. Don't forget here we said trade receivables is an asset and it was debited. Trade receivables is a liability and liability should be credited. Carriage inwards is an expense. Please, if you haven't watched the double entry videos, I would refer you to that where we're explaining, return inwards, return outwards, carriage inwards, carriage outwards. Carriage inwards is an expense. Carriage inwards is an expense to your purchases. So that is, you add that expense to your purchase expense. So, and that is to be debited. That is to be debited. Carriage outwards is also an expense. Carriage outwards is also an expense. It is an expense to sales. It means that, we've sold things to our customers. This is the cost of postage, delivery, and all of that. That reduces the sales amount. So you would usually subtract our carriage outwards from the sales. Whereas with your carriage inwards, you would usually add that to your purchases. Okay, and so this is it. I hope this is clear. And if you remember, it was in the first video on accounting circle where we had given, a short an acronym from how you can just, help yourself in remembering what is to be debited or credited, and that was dead click. We had something called, I can write that here, dead click. And we have said that what you're going to be debiting, so this is D, you're going to be debiting your expense, your assets, and your drawings. Those will be debited. You're going to be crediting, so increase in expense, assets, and drawings is going to be debited. Increase in liabilities, income, and capital should be credited. So that helps you to remember, what should be debited and what should be credited. Okay, so let's try this. We have an example. The following balances were extracted from the ledger of P. Harvey, Patricia Harvey, on the 31st May 2016. We're told to place the figures in the debit or credit column and total them. So now this, the ledger accounts has been prepared, and this is the balance brought down on each of these ledger accounts. So each of these ledger accounts has been prepared, and this, as we've been told, this is the ledger of P, and these are the brought down figures. These are the brought down figures, the closing balances. These are the closing balances. Now we are told to then, use it to prepare trial balance. Which side of the trial balance are we going to put this in, debit or credit? So we have capital. Capital, if you remember the dead click, is credit. So you should have a credit balance, and that's where our capital would be 16,000. Sales revenue income should have a credit balance as well. So 50,000 should be credited. Inventory is a current asset. Inventory is a current asset that should have a debit balance. So we'll put 9,000 there. Purchases is an expense. An expense should have a debit balance. So we're going to put up, expense purchases here. Furnitures and fittings, 13,000. Furnitures and fittings is an asset. It's a non-current asset, and an asset should have a debit balance. So we have assets there, 13,000. Motor vehicle is 8,000. Motor vehicle is an asset. It's a non-current asset as well. So that should also have a debit balance. Rent paid. Now we have, interesting, we have rent paid, we have rent received. Rent paid is an expense. It means it's the money you're paying for the renter of your premises or the office space you have. Rent paid is an expense. An expense should have a debit balance. So we'll put that in debit. Bank overdraft. Bank overdraft means it's an obligation. You've taken something from the bank, a short-term loan from the bank. It's an obligation, so it's a liability, and liability should be credited. So we put that on the credit side. Rent received, now this is now different from our rent paid. Rent paid, we said it was an expense and we had debited it. Rent received is an income. Income, sales, revenue, all of those should be credited. And then this is the postings. This is how we should have posted, all of these balances. The key thing with the trial balance is that both sides of the trial balance, the debit and the credit side, has to be equal, and then we know that we're right or we're wrong. So we need to sum up 9,000, 3,600, 13,000, 8,000, 6,000. If we sum that up, we should have 79,600. For us to be right, it has to be equal to whatever we have here. So if we sum up 16,000, 50,000, 8,000, 5, 6, and it doesn't give us 79,600, we know that something is wrong. We need to go back to our journal and our ledger postings. So if we sum all of these entries also, we should have 79,600. And I hope this is clear. So this tells us that, we have posted things rightly, and this is our trial balance. Okay, so you want to maybe pause the video now and try recording these transactions first in your ledger accounts. So you balance up the ledger accounts, and you want to take then the balancing figures in each of the ledger accounts and post it in your trial balance. So I'll start with the first one, and you do all of the other ones. The first one says James paid 20,000 into the business account in order to start the business. He's starting a business, so we know that's capital. So we know starting the business with 20,000. The two elements of this transaction is we have capital, and then we have this capital amount of 20,000 was paid into the bank account. So we have bank. So we have bank and we have capital. So those are the two elements that are involved in this transaction. So if you open the ledger accounts of capital and open the ledger of account for bank and you make the postings, the balance broke down for each of them is what you're going to then take into your trial balance. So you do that and use, your ledger balances to then open up, to you then use it to draw your trial balance. Use that to draw your trial balance. So far we've looked at, what are the accounts when we look at the transaction, how do we identify what needs to be done, how do we then post that into into our ledger accounts, and then how do we draw up our trial balance using the balances of the ledger accounts. We'll be stopping with that for now. In our next video, we'll move to preparing financial statements. So far, we've identified transactions, we've recorded journal entries, we've posted into ledger accounts, and now we have just been able to see how we can draw up our trial balance. In the next video, we'll be preparing financial statements. I'll see you then.